I created this investing framework for you, and I don't know who needs to see this, but if you're watching this, I hope it helps you, right? Because unfortunately, some of us begin our investing career in this quadrant, the gambler quadrant, low skill, high activity. And fortunately, there are trading companies who have gamified investing. The fortunate part is they've helped reduce the friction of trading, which is great. But the bad thing is it can be abused. And even Warren Buffett has been quoted saying that he's concerned that some of these trading companies have created little casinos in people's pockets, right? And if you think about this, why is this scary, or why could this be bad? Well, you could make a very speculative, concentrated bet and be right. And that could be the worst thing that ever happened to you, because now you think you're smart, you think you did it, you think you beat the system, and then you think it's sustainable and repeatable, and you do it again. And see, that's where the problem is, right? Where we get all these behavioral biases, like hindsight bias, overconfidence. But you see, you have to judge the process, not the outcome, because, for example, you could go to a casino, you could put all your money on black, and you could be right and double your money, and wow, that was incredible, right? But that is not sustainable and not repeatable. And the reason that could be the worst thing that ever happens to you, because you can think you can do it again, put all your money trying to double it once more on black, and this time it's red, and you lost everything, right? And so again, you got to judge the process, not the outcome. Was it a good decision, right? Without knowing the outcomes, that's the thing about investing. You don't know the outcome. There is uncertainty. That is the definition of risk, that it can go down, that you do not know. But you would expect, higher returns than inflation, or you wouldn't take on that risk, right? Okay, so anyways, gambler, you are in this section. If you are trying to time the market, you are making decisions based on speculation. You are either giving or receiving investment advice at the Thanksgiving dinner table. There is a reason that this next quadrant, the boglehead quadrant, is the best quadrant for the masses to live in. So the founder of Vanguard, right, has really kind of started the trend. I would call him one of the first guys, one of the first good guys on Wall Street. And the reason is because he made low cost investing cool, right? And he basically highlighted this thing, if I go back, keep costs low, keep it simple, stay the course. And there's even a boglehead book that talks about the 3-fund portfolio, total US, total international, total stock, or total bond. And so really, when you think about that, this quadrant is low skill. It's pretty easy to buy a low cost, globally diversified portfolio through Vanguard ETFs. And there's low activity. You just buy and hold, maybe occasionally rebalance or something, right? But anyways, low activity, low skill. It's so easy. That's why it's so advisable to the masses. Now, if I were to take a pivot and even show you this, okay, we're going to go to Spiva. And we're going to see, okay, why is the boglehead quadrant so dang good? Well, in any given year, look, this is research that shows data, that percentage of all large cap funds that underperform the S&P 500. Okay, well, with the current data they have as of December 31st, 2024, only a third of the funds in a given year outperform the S&P 500. And it's like, okay, well, that, the odds still aren't in your favor, but it's like at least a decent chance, right? Well, many of you are investing not for a year time horizon. In fact, if you have any money invested for a year, it better be in like a CD or money market or an individual bond that matures, because there's no guarantee that in 1 year the stock market is going to be higher when you actually need that money, right? Instead, your money that's in equities is long-term money. It's probably more like 10-year money or 15-year money. And as you zoom out, you can see that over long periods of time, the percentage of funds that outperform the index goes down, right? So the odds are not in your favor. Is it possible to outperform? Sure. But is it likely? Net of fees, net of taxes. Well, here the data clearly says, no, it's not. So you may be part of the 10%, or you may have hired somebody who's part of the 10%. But again, the odds are you're probably in the 90%, right? And so again, if I go back to here, that's why this quadrant, the bullhead quadrant, is such a good quadrant. They're not trying to beat market expectations. They're trying to capture the market, right? They're trying to reduce as much friction as possible and at least just capture. It's essentially saying, I'm betting on humanity and on capitalism, that over long periods of time, all right, that we will produce more goods and services more efficiently, right? That's essentially kind of that philosophy. There are two categories that are trying to outperform the market, right? And I would start here, high skill, high activity. These are your quantitative managers, right? And the best quantitative manager example there is Renaissance Technologies. In fact, they are so good at what they do that they don't even manage anyone else's money. They only manage their money in their one secret fund. It's so top secret that you have to sign a lifetime non-disclosure to work there. And, I don't even want to think about what happens to people who break that non-disclosure. I mean, it is like top secret, right? Whatever they're doing. But the idea behind Rentec or quantitative investing, right? If you think about it, if you can be right 60% of the time, every time, thank you, Acreman, for the reference, or even just 51%, if you can be 51% right every time, well, now you have a money printing machine, right? And so Rentec has cracked the code, and they've actually never had a down year in their fund, and they're crushing it. Definitely the poster boy example of hedge fund managers. But another example of this quantitative investment fund manager would be Dimensional Fund Advisors, right? So they are similar to Boglehead in that, low cost, globally diversified, but they add an active component to it. And this quantitative investing, why can that be so helpful? Because there are times where maybe markets overreact, and being active allows you to be nimble there and adjust. Let me give you a perfect example. S&P 500, a lot of people think it's the top 500 companies in the top 500 largest companies in America. Well, that's not exactly right? So if we think of Tesla, by market cap, it was one of the largest 500 companies in the nation, but it was not included in the S&P 500 for a while because it didn't have 2 quarters of profitability. But as soon as it started selling carbon offsets, it got profitability, and then it was reconstituted into the S&P 500 index. Well, the reconstitution is like this big rebalance for the S&P 500. They announce, which companies are leaving and which companies are coming in. Well, Dimensional Fund Advisors, if they know, like, hey, and this is getting a little in the weeds, right? But if other fund managers who are trying to track an index, well, they don't want tracking error. They want to match the index as much as possible, right? And so they're going to reconstitute their funds on the same day that the index reconstitutes their funds or rebalances their funds to avoid tracking error. Well, Dimensional Fund Advisors, they're going to say, hey, if we know there's going to be a lot of people buying and selling certain securities on certain days, well, maybe we can get ahead of that and get a better spread on that trade, right? And so I don't know, that's an example of maybe slightly higher activity, higher skill, using data research, and Dimensional Fund Advisors, they've really over long, I love this, the scientific pursuit of higher expected returns. They've really found that there are these premiums that over long periods of time tend to outperform, right? Value tends to outperform growth. Obviously, we have not seen that. Growth has been, almost an anomaly, but over long periods of times, value tends to outperform growth. Small cap stocks tend to outperform large cap stocks, and profitable companies tend to outperform unprofitable companies, right? So those are some of the active overlays that they're putting into kind of this low cost, globally diversified boglehead thing. So anyway, there's a lot there. All right. Now this last quadrant, the Warren Buffett quadrant. So this is high skill and lower activity than the quantitative investing. Think qualitative investing. So Warren Buffett, famous at finding undervalued companies and holding on to them long term. One of his famous quotes, be fearful when others are greedy, and greedy when others are fearful. So higher skill, less activity. Well, a really good example of that, is taking a contrary position to a market overreaction. And one of the best market overreactions that we saw was the GameStop phenomenon in 2020, right? In 2020, nobody would have had a crystal ball, to see COVID in the first place, right? But nobody would have known that, hey, when GameStop was selling $4 a share and people were shorting it because, because physical gaming is dying and all these things, nobody would have known that it would balloon up to $400 a share, right? You would have had to have a crystal ball to know that. But once it's already ballooned to $400 a share and it has a very bloated market cap, now all of a sudden you don't need a crystal ball to know that, hey, short term the market voted, but long term the weighing machine is going to win. And so, right, and so that would be an example. I'm sure there are some people that made a lot of money on it going up. There's a lot of people that lost money on it going down, or fear of missing out and buy high and they probably sold low. But then there's also some people, when they think about short-term voting machine, long-term weighing machine, that they were able to take a contrary position, right? And recently we saw this with Newsmax, a very similar thing, on the first day of IPO, up 700%. Holy cow, that's crazy. By Tuesday it doubles again. It's like, wow, this is so. In this moment, I'm thinking, holy cow, this is a short-term voting machine, and long-term, the valuation, especially, at this point, at this peak, the company was valued at about $20 billion. And keep in mind, the year before, 2024, they only had $171 million of revenue. And with that $171 million of revenue, they still had a $72 million loss. And million with an M, right? But their market cap valuation was billion, over 20 billion with a B. And so it doesn't take a rocket scientist to know at this point, hey, this is the short-term voting of the market, but long-term, the weighing machine of the market is going to do its work. This is at MarketWatch allows you to run a simulation. So I'm in the simulation, and we actually won the competition by implementing this framework and observations. This framework helps you understand, which type of investor you are and whether you really want to try and go for higher expected returns in one of these two strategies, quantitative or qualitative. And whether you're going to do that yourself in your own research and analysis and observations, or you're going to pay somebody to do that for you. Or the reality is I feel comfortable if the masses were in this quadrant. I'm trying to move people from gambler to boglehead only because it literally stacks the odds in your favor for long-term success and higher terminal wealth. But for those people who like baseball, here's what I'll say. I'll give you an analogy. Maybe you really you have money that you can swing for the fences. So the thing about swinging for the fences is you have to be okay with striking out. Like home run, it's great. It's better than a base hit. But there's probably more chances of striking out when you're swinging for a home run than when you're just trying to get a base hit. For people who have this itch, then I would say, look, I would call it the core and satellite strategy or approach. With your core portfolio, with the majority of your money, take this approach. It takes low skill, low activity, and the odds are in your favor. It's great. And if you happen to have extra money because you live within your means, you've saved the difference, and you've been patient with compound growth here, you happen to have extra money that you want to swing for the fences, but it's not going to hurt you or delay your retirement if you're wrong. And again, one of the worst things that could happen to you is that you're right, and then you get over concentrated in your next position thinking it's sustainable and repeatable, and it's not. Anyways, that's my fear. But that core and satellite approach, that's one way I've seen this work, where people can feel, or maybe even better than this, like I just showed you the market simulation. Why don't you just open up a simulation and then you're playing with play money, and then you still get what you really want is just the bragging rights at the next barbecue, the neighborhood barbecue. You can be like, oh yeah, I knew this was going to happen. Yeah, and you have something to talk about. Great, do it here with fake money. But let your retirement money, stack the odds in your favor. But anyways, find which quadrant that you align with, and let's start winning the money game. Let's start making better decisions with our money. Anyways, thanks for watching this YouTube video. I hope you found it helpful. Again, general education, not investment advice, but I hope you found this investing framework helpful.